Well, to most people, the world of investing is a dark mystery. You might have a pension plan of some type through your employer or a small amount of savings in your RRSP. The question on many people's minds these days is, how do I make money beyond the interest in my savings account? Well, Robyn Thompson, certified financial planner at Castlemark Wealth Management, is here with a few tips to help you increase your bottom line. Robyn, thanks for joining us.
It's nice to see you as always.
Thank you. And in the world of stocks, bonds, and mutual funds, where do people tend to start?
Well, if you have managed to accumulate some cash inside your savings accounts, your RSPs, or your tax-free savings accounts, you might be a bit frustrated with the 0.5% return on your investment from your local bank or financial institution. And that may have you start to look at building out an investment portfolio for you where you can start to booster some of those returns so you can actually make a return above 0.5%. The first place to start is really to ask yourself, how much risk am I willing to take with my money? Second question is, what is this money supposed to do for me? What are my investment objectives over the short, medium, and long term? Once you have those two questions answered, you can then look at the investment product landscape to look at mutual funds, and there's over 19,000 of them, so there's lots to choose from, or exchange-traded funds, and of course stocks and bonds. If you're a more aggressive investor, you might look to hedge funds, commodity pools, derivatives, options, and the list can really go on and on. But you need to start with risk and objectives first.
Okay, once you get the risk and the objectives all taken care of, is there a simple and safe approach that investors can take, especially when they're just dipping into the market?
Well, thousands and thousands of people, Tammy, invest in the stock and bond markets every single day, and they do manage to make money. So when you look at making money, again, it's about the risk. So in my portfolios, I like to use what's called a couch potato approach or an indexing approach, and I call it the smart cookie approach. So essentially what you're looking to do, and you're looking to create a portfolio that has low maintenance, that's diversified with low fees, that tracks or makes the same returns as a specific stock or bond index. Over periods of time, this type of strategy actually outperforms active managers and the vast majority of mutual funds. So it has transparency, it has lower fees, it's tax advantage if it's in a non-registered account, and it tends to outperform most managers.
Okay, you mentioned couch potato. Where does that name come from exactly?
Well, back in 1991, there's a writer by the name of Stephen Burns, and he writes for the Dallas Morning News. And he put out an article that suggested that you put half of your money inside of an index fund that mirrors the S&P 500, which is the U.S. market, and you put the other half into a bond index that mirrors the entire U.S. bond market. At the end of each year, you take a look at your assets, you divide it by 2, and you make sure that you have half of your money inside of the bonds and half of it inside of equity. Now, that's where the couch potato come from. I like to take it a step further because I don't think that 50% equity exposure would be appropriate for every investor. It really comes back down to the risk, but that's where the couch potato portfolio came from.
Okay, and also you asked as well, you had offered really the advice that if you do want to get into the stock market, you do have to think about the risk and the goal. What are some of the important questions that you really need to ask yourself in order to get to that, to find out what your risk level is, and to also find out what exactly should your goal be, and how long should you give yourself to hit that goal?
Well, I think that when you look at short, medium, and long term, so short term would be things like anything from cars to children's education. Long term obviously would be about housing and retirement. So when you look at the investments and you look at putting money into a category or into a specific asset class, what you need to understand is that markets rise and fall. And if you put your money into the market and then you retire and you're overexposed to the stock market and the market crashes, and the money you have inside your portfolio doesn't necessarily have the time to make the money back that you've lost because the market's taken a crash and you're already retired. So the question would be is, in what time frame do I need to access this money? And if the market does fall to the bottom tomorrow, do I have the 5 or 6 or 8 years if it takes that long for the market to recoup? And can I survive off of that money? So it's really about, when do I need the money? What do I need the money for? And can I withstand the volatility in the market and the volatility in the portfolio within my investment holdings?
And last question, do you find that a lot more people are starting to dip into the market now, especially after the 2008 recession and that crash? Now that things are slowly going up, are people starting to take that risk and do it on themselves?
I do find that people sort of dip their toes into the market. They do want to make a return. They do understand that by investing in the market, you have the ability to make a larger return than the 0.5% or thereabouts interest that you're getting in your savings account. By the time you factor in inflation and fees, you're not actually going to produce a result with that kind of return. So I am seeing people start to come back to the market, but they are coming back to the market from a cautious perspective. They're not overstating the equity exposure. They're looking more into fixed income products, but fixed income products that pay dividends, or equities that pay a good dividend stream that are solid blue chip companies. So really people are looking for the strong blue chip companies, what's safe, what's secure. I still want to go with a company that has a strong reputation. I'm not looking to just put my money into short-term or long-term bonds, but I definitely see people starting to have some more confidence in the markets. But given that the markets are quite volatile, as you know, on an hourly and daily basis sometimes. So it's very important that you understand the types of investments you are investing in. You can invest on your own through a direct brokerage, but if you're confused or you need some more guidance, it's important to seek the help of a qualified financial advisor.
Absolutely. Thank you very much, Robyn, again for joining us.
You're welcome. Have a good night.
You too.